So when you start out in your real estate career, most people start out with, I want to buy houses, I don't want to flip them. And then it's, I want to buy and I want to hold. And, because you want to gain equity appreciation because you're going off. Now I have to look. When you're buying and flipping, you're always having to look for the next deal.
Mm-hmm.
When you're buying and holding them, you're not realizing the profit from them if you don't structure them correctly. And it's all about structure. And what you're talking about is, hey, if I'm out there and you're generalized in your area, now you have a smaller market. But if you open your perspective and you go, okay, now I want to buy real estate and I might own properties by accident. And it's not even as much by accident as it is selective. So what we're talking about is, you can become a hard money lender. Now you just open yourself up to a network. Okay. So what I'm talking about is there are so many like meetup groups. You listen to a podcast a lot, Bigger Pockets, mm-hmm. right? Okay. So they have meetup groups everywhere. Well, yep. The great news is that you're already establishing the fact that you have some money that is available that you can use. Okay. So now it's a matter of a one-on-one relationship. So I'm going to back up just a second. Here you've built up some equity with whatever it is. Maybe it's in your house, maybe it's in cash, whatever it is. Now you want to put that to work. So where do you go? What are your choices? You go down to the bank, you buy whatever you're going to buy, whatever services that they have. On the flip side of this, though, if you're going into a real estate market, you can say, I have the money to lend and I want to hold as a security interest the mortgage deeds of trust on the property. And that allows you the flexibility that the property doesn't have to be located in your area. It can be located anywhere. Right? Perfect. It also, the mortgage lender doesn't deal with the tenants. They don't fix toilets.
Right.
Really the evaluation for you is how much is it worth and how much am I lending? That's it. And you'll become a real estate owner by accident. You can actually selectively look at transactions that you think, they may or may not pay me back. So if you're looking at a $100,000 house and just like that mentor of mine, you go, how much would I pay for that? I'd buy that for 60. Mm-hmm. I'd pay 60,000 for that. I'll loan 60,000 against it. And then what happens is your rate of return, your hard money, now you have an income off of it.
Right.
Here's a steady income. You get to choose the rate. Now, the only caution that I can really come up with is for what purpose is this being loaned? So there are laws out there that protect consumers, and that applies to owner occupants.
Right. Okay. So that was put in place by the Dodd-Frank Act, right?
Right.
So can't lend on the owner-occupied properties, only investment type. Right.
And if you do lend on owner-occupied properties, it caps the interest that you can charge. If I'm going to use myself as an example, let's say that you and I get into a transaction, and I say, "Hey, Cameron, here's a deal. It's $50,000 in first position, and the place is worth $100,000." Okay. So it's an evaluation. You go, that's great. And you can charge 12% interest and you can have points. So interest rate is just that rate that's charged. That's a monthly income. The points are a fee associated with it. So if there's 12% and 10 points, so you get $5,000 in points right away. That's immediately, if I borrow money against a project and I'm the borrower and I borrow it, then it's going to be $5,000 the next day after that loan is initiated and in place that you have to be returned. So I have to return $50,000 plus 10%, which is $5,000, plus at a 12% annualized interest rate. If I paid it back the next day, I'd have 1 day worth of the 12% per diem. And so really what you should be doing as a lender, as a smart investor, you should be going, I hope he doesn't pay. Because if you can get into deals where you hope the borrower doesn't pay these ridiculous fees, then you have to be happy with the fact that they did. right?
Right.
But if you can put your head on the pillow going, if he doesn't pay, I get $100,000 property that I can foreclose on for $50,000. And if he does, I get $5,000. So my rate of return is going through the roof. That's a perfect vehicle to use for home equity lines of credit or debt equity, right? So a person has their house, equity in their house. I'll show you this. I don't know if I did this. So let's say that there's a property that has a $60,000 first on it. I'm using round figures because it's easy, and it's worth $100,000. There's $40,000 in equity. So this part right here is borrowed against, and this part is the equity. This equity that they have placed at 12% with an average of 6% in points, so 18% returns. People look at that and go, what? 18%. Investors, real estate investors, use them all the time. I found a property, I want to buy it. I have to act fast. I'll borrow money at a higher rate just to be able to secure it and get it in. Because I might be buying a property that's worth $100,000 for $70,000. I need 50 in a loan because I have 20 of my own. So I go to you and I go, okay, I'll borrow your money. And I don't care if it costs me $5,000 because I'm buying $30,000 in equity. So if I give you 5 of it in points plus interest, I don't care. I just still made $25,000. It's all about, making that deal work. So with this 40%, if you get a HELOC on that, and now you have $40,000 out there, $40,000 at 18%, this portion of your equity will pay the entire balance of your underlying.
So in this example, this is assuming that I'm borrowing against my own house.
Right.
Okay.
Right. Let's say that you're sitting there, you go, okay, I own a home free and clear. Okay. You go out there and you borrow against it. You can make a return on that. And the return that you make by buying deeds of trust that are current or loaning money as a hard money lender, the whole game is I'm putting it out and making 12%, and my HELOC cost me 5%. So I make 7% on nothing more than the difference in the interest rate. But the better reason to do it is I'm taking what is a second position here in my equity, and I'm converting it and putting it into a first position on property worth twice as much. So the very act that you're lending money in a secured position against property worth twice as much, or a third more than your loans. If it's $100,000, you're maybe at 60 or 70% loan to value or under. The very act of doing that means that your money is more secured than it was in second. What if this property falls 5% in value? It hasn't hurt you at all.
Right.
You still have the money out. But if you put it into a property and you loan $40,000 against a property worth $80,000, now the $80,000 property comes down, it's only worth $75,000. It has to fall all the way down to where it's only worth half its value to even start affecting the security of what you bought. Does that make sense?
It does.
Okay. So most people will go back to what we talked about earlier, and they say assets and liabilities. And a liability is something that takes money out of your pocket. Here's a way to turn a liability into an asset.
Right.
Is by saying, there's equity within my home, and I can turn that into a cash flow item, and that can help provide a number of different things. It will provide income, it can provide shelter and asset protection for it, so that it's not subject to the whims. I'm worried. I don't buy stock. I don't, because I just feel like I don't choose those as well. But I know something of value when I see a piece of real estate. And I know, okay, how much is that worth? What do I think I could sell it for? And what are various ways differently that I can still turn that asset into cash flow? For instance, if you bought a property that was in Detroit, okay, and you go, okay, there's a lot of people that are buying property there that are really cheap. Let's just say it's $50,000. It's probably less than that.
Probably less.
Yeah. But whatever the value of it is, it's like, it's just a matter of the denomination of bill that I start to use as an example. Are we going to pull out 100 or are we going to pull out a 20?
Right.
Right. It's about the loan to value against that. So just take that and say, I'm only loaning a fraction of its value.